Hi, I'm Emma Wall, and joining me today is M&G's Jim Levis to talk about bonds. Hi, Jim.
Morning.
So, what has happened to bonds since the beginning of the year and the onslaught of coronavirus?
Well, it depends what kind of bonds you're thinking of, really. So, if you're thinking about the safest bonds, government bonds issued by Germany, Japan, the US, gilts even, they've rallied substantially and pretty much down to their all time lows in yields as governments and central banks have promised to do whatever it takes. And that includes buying huge numbers of government bonds as part of new quantitative easing policies. Credit and corporate bonds, high yield and emerging markets has been a very different story, though. And you saw in March in particular, people just fled from risk assets, whether that was equities or corporate debt or high yield. And as a result of that, you saw spreads, the yields that you get on corporate bonds relative to government bonds skyrocketing. And at one stage, you had the entire US high yield market trading as if you were going to see pretty much all of it in distress with a high probability of defaults almost anywhere. Since March, though, again, governments have done the right thing, stepped in, been very supportive, said that they will buy not just government bonds, but also corporate bonds, and a lot more tranquility and calm has come back to the market, and prices have recovered across the board, really.
I suppose it's a real lesson in why you bother to diversify a portfolio. And I'm not just talking about between equities and bonds, which, of course, as you say, has provided some buffer, but also within your fixed income allocation, because you do get this divergence in opportunity set and indeed in performance when you have an event such as this.
Yeah, because bonds isn't just one asset class, it's effectively lots of little asset classes. And we mentioned high yield, which are very risky, but have yields of maybe 10%. Emerging market debt hasn't recovered really yet since the March sell-off because they have less developed health systems and tracing's more difficult and so forth. So that's still an asset class with extremely high yields relative to where they were a year ago. Government bonds, inflation-linked bonds, and then you have currencies as well. And currencies, if you're a UK investor, also provide you with some diversity away from the UK's economic and health prospects. So yeah, I think it is important to have a kind of multi-asset approach to fixed income, just as you probably would within your equity portfolio, where you don't have all your eggs in one type of equity.
And I know it's very difficult to tell what's going to happen over the short term because there is so much uncertainty. But have you been looking at picking up opportunities as there have been these sort of changes in price and indeed yields over the last couple of months with a view of looking through to sort of longer term opportunities?
Yeah, well, I think if you're thinking about corporate bonds, lending to companies, the most important thing is, am I going to get my money back? And am I being compensated for the risk? Because there's always a risk. There could be fraud. You don't know, something like coronavirus comes out of the blue. You can't really plan for that. So you look for companies with strong protection, so good assets that you as bondholders, you're first in the queue usually, or near the top of the queue if something goes wrong. So you look for good assets behind you, and you look for a yield that compensates you for the defaults you expect. So that allows you as a bond fund manager to even say, I really don't think the prospects in this sector or for this company are very good, but I'm getting paid something that's implying it's going to go bust this year. And if I know that isn't going to be the case, then that gives you the opportunity. And March really threw up just thousands of those opportunities because suddenly everything was trading as if the world was going to come to an end. And I know it feels like that most days at the moment, but we know we are going to get through this eventually, and that most companies will survive thanks to existing strong franchises and also thanks to the support for government. So what we did in March was really quite heavily buy into credit, into corporate bonds, because we do have this backstop from the Bank of England, from the Federal Reserve, from the ECB that said, the Bank of England is out there every day buying corporate bonds. And that really gives you a lot of confidence that liquidity will remain okay. We have to be careful always about liquidity, but liquidity will remain okay. And that prices are supported by this huge organisation that can press a button on a photocopier and make more money to buy those bonds. So there's no kind of limit to what they can do. And so March was an incredible opportunity for bond investors who invest in credit to pick up things for the long term, knowing that, things may not recover quickly, but even if they don't, the valuations were right.
You touched there a bit on what central banks have done and how that's impacted the corporate bond market. Can we talk a little bit about govies? Because unprecedented has become the kind of word of the last 3 months. And when you look at yields on government bonds, I mean, we thought things were low a year ago, and some of the levels that have been reached over the last 3 months have just been quite eye-watering. How do you navigate that market as a fixed income investor when you're basically guaranteed to lose money at certain levels when inflation is at 2% and gilts offer you a tenth of that?
Yeah, although we're going to have a period of deflation, I think that's almost certain now. Oil prices going negative, inflation is going to fall substantially, let alone lack of demand, holidays, flights, all of that stuff. So I think the risk at the moment is not one where we worry about inflation. Further down the line, when we come out of here, we are going to see months and quarters of the strongest economic growth in history. The rebound is going to be fierce. All the people that have been put out of their jobs are going to come back into the market, and we don't know who's going to have the upper hand, whether it's going to be capital or labour at that point. Maybe Labour says, I'm not going to go back to this company that laid me off. I'll go and try and find somewhere who'll pay me more money. And so we don't quite know what the dynamic will be, but maybe some inflation in a year's time or so is something we should think about. But when we think about government bond valuations, every year, every January, you see all the forecasts come out from economists, investment banks, asset managers, and they've been incredibly bearish every year for 30, 40 years now. And every year bond yields are carried on falling. Bond prices kept on going up. And I think if you want to genuinely say that this is time to call the end of a 40-year bull cycle, you have to believe in three things. You have to believe that there isn't still going to be demand for fixed income, safe assets, income-producing assets. And we've got an old, ageing population, and we know that ageing population needs that income and security. And we know that people are living longer. Coronavirus may put a dent in that for a year or so, but generally our health experience is one of living longer and being more healthy in our old age, and we need some fixed income for that. So I think that trend remains in place, albeit with this year being a bit of an outlier. Secondly, technology, and the technological changes we've seen over the past 40 years have been huge, and internet shopping means that you and I can find the cheapest thing wherever it is in the world and have it shipped to our house at a price cheaper than the shop round the corner. And that's also true for companies. Things like Uber have made taxis cheaper. The technological impact of consumer prices has been dramatic, and there's also an impact on wages as well. And the robots stealing our jobs argument, that eventually a clever AI will be able to do your and I jobs, our jobs for us, and that will put a cap on what we can earn, even in good jobs, not just manufacturing jobs that have been disintermediated by robots. That will come for the high-paying jobs as well as the low-paying jobs. And so that trend remains in place and may even get more severe, and that will keep inflation low and bond prices high. The one that I think there is some doubt about is globalization. And obviously, bond prices have been kept high because inflation is low thanks to China, cheap goods, cheap labour coming to the UK from Eastern Europe, for instance. And you might say to yourself, well, both coronavirus and more quarantine, more insularity, more determination to have your own supplies of goods in your own country and your own food, to not rely on China to produce your PPE and etc., might put a brake on globalization. And globalization was already under threat a little bit from things like Brexit, from Donald Trump. And so I think of the three big secular changes, aging populations, inflation, impact of technology, and trade, globalization, it's the last one that might say that's going to be a threat.
Jim, thank you very much.
Thank you.